Imagine it's December 1st, 2001. You're a dentist named Carlos living in a middle-class neighborhood in Buenos Aires, Argentina. You have a wife, 2 children, a modest savings account denominated in US dollars at a reputable Argentine bank. You've done everything right. You've saved. You've been responsible. You've trusted the system. And this morning you woke up to discover that the government has frozen every bank account in the country, yours included. The policy is called the corralito. It means little corral, like a fence for animals. And that is exactly what it is. Your money is now trapped behind a fence you cannot climb. You are allowed to withdraw 250 pesos per week. That's it. Your life savings, your children's education fund, your emergency reserves, all of it locked behind a government decree signed at midnight while you slept. Within 3 weeks, the Argentine peso, which had been pegged 1-to-1 to the US dollar for a decade, is forcibly devalued. Your dollar-denominated savings are converted to pesos by law. Then, those pesos lose 70% of their value. You did not make a bad investment. You did not gamble. You did not speculate. You simply believed the financial system would honor its promises. And in the space of 30 days, you lost everything you had built over 20 years. Now imagine another family. They live 4 blocks away. Same neighborhood, same income bracket, same profession, actually. The husband is also a dentist. And yet, 6 months after the collapse, this second family is not standing in line at a shuttered bank. They are not rationing food. They are not choosing between electricity and school fees. They are strained. Yes, they are uncomfortable. But they are intact, functional, solvent. The difference between these 2 families is not luck. It is not insider knowledge. It is not wealth. The difference is a series of quiet, undramatic decisions made months, and in some cases years before the crisis became visible. Decisions that looked strange at the time. Decisions their neighbors didn't understand. Decisions that, when studied across dozens of economic collapses, spanning a century of financial history, turn out to be almost identical every single time. This isn't theory. It's documented history. And the pattern is so consistent across so many different countries and decades that ignoring it requires genuine effort. Most people believe that surviving an economic collapse is about prediction, about timing, about knowing when the crash is coming and getting out just before it hits. That belief is wrong. And it's wrong in a way that matters deeply because it leads people to do exactly the opposite of what actually works. The families that survived the Argentine crisis of 2001, the families that came through Weimar Germany in 1923, the families that endured the Greek debt crisis in 2010, the families that outlasted the hyperinflation in Zimbabwe in 2008, they did not predict the timing of the collapse. Not one of them. What they did was something far less dramatic and far more effective. They organized their lives so that a collapse, whenever it came, whatever form it took, would not destroy them completely. They didn't predict. They prepared. And there is an enormous difference between those 2 things. The reason this distinction matters is structural. Economic collapses do not announce themselves with a single event. They unfold in stages, and by the time the average person recognizes what is happening, the most important exits have already closed. Capital controls come before the devaluation. Bank holidays come before the restructuring. Import restrictions come before the shortages. The sequence is almost always the same, and the families who survive are the ones who acted during the early stages, when the moves still looked unnecessary, when their friends told them they were overreacting, when the government was still insisting that everything was under control. Let that sink in. The window for effective action is precisely the period during which action seems irrational. That is the trap. And it is a trap that has caught the middle class in virtually every monetary crisis in modern history. To understand what these families did differently, you first have to understand the anatomy of a collapse, because the decisions only make sense when you see the sequence they were responding to. Every major economic collapse in the last 100 years has followed a remarkably similar architecture. The details change, the currency changes, the country changes, but the skeletal structure is almost identical. Stage 1 is the accumulation of imbalance. This is the longest phase and the least visible. It can last years or decades. Debt grows faster than productive output. The government runs fiscal deficits that expand slowly enough to seem manageable. The central bank accommodates those deficits with monetary policy that is slightly too loose, year after year, compounding quietly. The currency appears stable because confidence, not fundamentals, is holding it in place. During this phase, virtually everyone is comfortable. Asset prices are rising, credit is available, wages may even be growing in nominal terms. There is no reason to worry. And so nobody does. Stage 2 is the emergence of stress signals. These are technical, obscure, and easy to dismiss. The spread between government bond yields and benchmark rates widens. The central bank begins intervening in foreign exchange markets more frequently. Capital outflows increase, but they're reported as normal fluctuations. Inflation begins to drift above target, but the government changes the way inflation is measured, or blames external factors, or both. During this phase, the people who will eventually survive the collapse begin to act. They do not wait for confirmation. They respond to the stress signals themselves. They recognize that the pattern has started, even though the endpoint is not yet visible. Stage 3 is the political response. This is where the government begins to make choices that accelerate the collapse while appearing to prevent it. Capital controls, price freezes, bank withdrawal limits, currency pegs defended at unsustainable cost, nationalization of private pension funds, forced conversion of foreign currency deposits. Every one of these measures is presented as temporary, as stabilizing, as necessary. And every one of them traps the middle class further inside a system that is failing. Argentina did this in 2001. Greece did this in 2015. Cyprus did this in 2013. Venezuela has been doing this continuously since 2013. The playbook does not change because the political incentives do not change. Governments in crisis protect the system first, the individual second, and the saver last. Stage 4 is the rupture. The peg breaks, the currency devalues. The banks reopen with new terms that nobody agreed to. Savings are redenominated, restructured, or simply gone. Inflation accelerates beyond the government's ability to manage the narrative. Prices disconnect from wages. The informal economy expands because the formal one has become non-functional. This is the phase that makes the news. This is the phase that people remember. But by the time it arrives, the outcome for most families has already been determined. The decisions that mattered were made in stages 1 and 2. Think about what that means. Now, the families. What do they actually do? And why do the same behaviors keep appearing in every documented collapse? The first thing that stands out across every case study, every country, every decade is this. The families that survived did not have more money. They had more optionality. Those are different things. Money is a claim on a system. Optionality is the ability to function when that system fails. In Buenos Aires in 2001, the families who came through the crisis with their standard of living roughly intact were not the wealthiest families in their neighborhoods. Many of the wealthiest were destroyed because their wealth was concentrated inside the Argentine banking system. High balances, long-term certificates of deposit, government bonds, all of it frozen, converted, devalued. Their wealth was a number in a system that stopped honoring numbers. The families that survived had done something different. They had distributed their exposure, not because they knew the exact date the corralito would be imposed, but because they understood, intuitively or through direct experience, that concentrated dependence on any single institution or any single currency was a structural vulnerability. Some of them held physical US dollars outside the banking system. Not large amounts, enough to cover 3 to 6 months of basic living expenses. They kept this cash in safes, in safety deposit boxes, at foreign bank branches, in some cases literally hidden in their homes. This sounds primitive. It sounds like something from a previous century. And it is the single most consistent survival behavior across every collapse studied. In Weimar Germany, it was gold coins and foreign currency. In Zimbabwe, it was US dollars and South African rand. In Venezuela, it was dollars, euros, and Colombian pesos. In Greece, it was euros withdrawn from bank accounts and held privately in the months before the capital controls of June 2015. The mechanism is the same every time. When the banking system freezes, the only liquidity that functions is liquidity held outside the system. The families who understood this did not need to predict the crisis. They simply needed to have a portion of their resources beyond the reach of a government decree. This is not a commentary on whether such behavior is ideal. It is a description of what actually worked. The second pattern is debt elimination before the crisis, not during it. This is counterintuitive to many people because conventional financial logic says that in an inflationary collapse, debtors win. The debt is denominated in a currency that is losing value. So in real terms, the debt shrinks. And in theory, that is true. In practice, it is far more complicated, and the complication destroys families. Here is why. In the early stages of a crisis, before inflation fully accelerates, the government typically raises interest rates dramatically to defend the currency. In Argentina, in the late 1990s, interest rates on peso-denominated loans spiked above 20%. In Turkey in 2018, the central bank raised rates to 24%. In Russia, in 2014, the key rate was raised to 17% overnight. If you are carrying variable rate debt during this phase, your monthly payments explode before inflation has reduced the real value of the principal. You're squeezed from both sides. Your income has not yet adjusted for inflation. Your costs have, and your debt service has multiplied. The families that survived had already reduced or eliminated their fixed obligations. Mortgages paid down, consumer credit closed, car loans settled, not because they predicted deflation or inflation, because they understood that debt is a fixed obligation in a world that was about to become deeply uncertain. and fixed obligations in uncertain environments are lethal. In Weimar Germany, the families that were destroyed fastest were not the poorest. They were the professional middle class carrying mortgages and business loans denominated in marks, whose payments became simultaneously unpayable in real terms during the deflation of 1920 to 1921, and then meaningless during the hyperinflation of 1922 to 1923. But only after the banks had already seized their collateral during the earlier phase. The timing mattered. And the families who had no debt had no timing risk. That's the mechanism. Debt forces you into the system's timeline, and during a collapse, the system's timeline is designed to protect the system, not you. The third pattern is the maintenance of productive skills and tangible assets. In every economic collapse, there is a moment when the abstract economy disconnects from the physical one. Prices on screens stop reflecting reality, salaries stop covering costs, the mechanisms of exchange, bank transfers, credit cards, digital payments become unreliable or non-functional. And in that gap between the abstract and the physical, the families that survive are the ones who can produce, repair, trade, or provide something tangible. In Argentina, doctors and dentists who could provide services in exchange for goods or informal payment continued to function throughout the crisis. Tradespeople, electricians, plumbers, mechanics found that their skills became more valuable, not less, because the formal economy had contracted, but the physical needs of life had not. People still needed their pipes fixed. They still needed medical care. They still needed food prepared and equipment maintained. The families that struggled most were those whose income was entirely dependent on the formal financial system. Salaried employees of banks, insurance adjusters, mid-level corporate managers, real estate agents in a market where no one could get financing. Their skills were real, but their skills were intermediated by a system that had stopped functioning. When the system froze, their ability to generate income froze with it. This is not an argument against professional careers. It is an observation about dependency. The families who survived had at least one member who could generate value independent of institutional infrastructure. A vegetable garden in Zimbabwe sounds trivial until the grocery stores have empty shelves and the currency you hold cannot buy what remains. A cousin who can butcher meat in Venezuela sounds like an anachronism until the supply chain collapses and protein becomes a negotiation, not a purchase. A grandmother who knows how to preserve food in rural Greece sounds quaint until the banks close and the pension payments stop and the nearest functioning economy is 200 kilometers away. Tangible assets followed the same logic. Families that owned physical goods with enduring utility, tools, fuel stores, durable food supplies, seeds, basic medical supplies, found that these items functioned as a parallel currency when the official one failed. In Zimbabwe, in 2008, a bar of soap had more reliable purchasing power than a $100 trillion banknote. That is not an exaggeration. That is the arithmetic of a currency that lost value faster than it could be printed. The fourth pattern is community, and this one is the least discussed and arguably the most important. Economic collapses are not just financial events, they're social events. The formal systems of trust, contracts, legal enforcement, banking, supply chains, all of these are mechanisms that allow strangers to cooperate reliably. When they break down, the only cooperation that remains is personal, direct, based on relationship, not institution. The families that survived every major collapse in modern history were embedded in networks of mutual support, not in an idealistic sense, in a deeply practical one. Neighbors who shared food, extended family members who pooled resources, professional colleagues who referred patients or clients to each other informally, church communities, cultural associations, even informal barter rings that sprang up in Argentina's middle-class neighborhoods, where a lawyer might exchange legal counsel for dental work, and a dentist might exchange dental work for tutoring, and a tutor might exchange lessons for food, creating a circular economy that bypassed the failed monetary system entirely. These networks were not charity, they were infrastructure. They replaced the functions that the formal economy could no longer perform. And the families who had invested in these relationships before the crisis, who had built trust and reciprocity when times were good, were the ones who could draw on those networks when times were not. The families who had isolated themselves, who had focused exclusively on individual accumulation, who had no deep ties to their communities, found that their savings, no matter how large, could not substitute for the absence of social infrastructure. You cannot eat money. You cannot perform surgery on yourself. You cannot guard your home 24 hours a day alone. The families who tried found out quickly that wealth without community is a vulnerability, not a strength. In Weimar Germany, the historical record shows that tight-knit communities in smaller cities fared measurably better than atomized individuals in Berlin. In Venezuela, the families that survived in Caracas were almost universally embedded in extended family structures that shared housing, food sourcing, and security responsibilities. In Greece, the rural communities with strong social ties experienced the crisis as a severe hardship. The urban professionals without those ties experienced it as a catastrophe. The mechanism is straightforward. Economic systems are, at their core, trust systems. When the institutional layer of trust collapses, only the personal layer remains. And you cannot build personal trust in the middle of a crisis. It must already exist. The fifth pattern, and the one that ties all the others together, is the willingness to act early and accept social discomfort. This is the real differentiator. Not knowledge, not wealth, not even skill. The willingness to look foolish. Every family that survived a collapse made decisions that their peers considered irrational at the time. Withdrawing savings from a bank that hadn't failed yet. Buying physical supplies when the stores were still full. Paying off a mortgage early instead of investing the difference in a rising stock market. Converting local currency into foreign currency when the exchange rate was still stable. Declining to buy property at what seemed like a reasonable price. Choosing to invest in relationships and skills rather than financial products. These decisions carried a social cost. Friends and family questioned their judgment. Financial advisors told them they were being inefficient. Neighbors thought they were eccentric or paranoid or both. And for months, sometimes years, those neighbors appeared to be right. The stock market kept rising. The currency stayed pegged. The banks stayed open. The system kept functioning. And the families who had prepared looked like they had made a mistake, until they didn't. In Argentina, the financial press was still publishing optimistic forecasts. In November 2001, the corralito was imposed on December 1st. The families who had withdrawn their savings in September or October had endured 2 months of looking foolish. The families who had waited for confirmation had their savings frozen. In Greece, the European Central Bank was still insisting that a Grexit was impossible in May 2015. The capital controls were imposed on June 29th. The families who had quietly moved euros out of Greek banks in April and May had endured weeks of being told they were overreacting. The families who trusted the official assurances woke up on June 29th, unable to withdraw more than 60 euros per day. In Zimbabwe, the Reserve Bank was still publishing official inflation figures that bore no relationship to reality throughout 2007. The families who had already shifted into foreign currency and tangible assets were already being called hoarders and speculators by the government. The families who trusted the official numbers held currency that was losing value by the hour. The pattern is identical in every case. The window for effective action is the window during which effective action looks unnecessary. The moment it looks necessary, it is already too late. The exits are already closed. This is the cruelest feature of the system. It punishes rational caution and rewards denial right up until the moment it inverts completely. And the inversion happens faster than most people can respond. Now, there is something important to address here, because the pattern raises an uncomfortable question. If the survival behaviors are so consistent, if the historical record is so clear, why do so few families actually do these things? The answer is not ignorance. The answer is incentive structure. During the accumulation phase of a crisis, which can last years or decades, the system rewards participation and punishes withdrawal. The stock market is rising. Property values are increasing. The bank is paying interest. The currency is stable. Every month that you hold your savings in the system, you earn a return. Every month that you hold physical cash, you earn nothing. Every month that you pay down your mortgage early instead of investing, you underperform your neighbor who used leverage. Every month that you spend time building community relationships instead of working overtime, your income falls behind. The incentive structure of a pre-crisis economy is designed, not conspiratorially, but mathematically, to maximize participation. And participation means exposure. And exposure means vulnerability. The system rewards you for increasing your dependency on it right up until the moment it fails. And then it punishes you for exactly the dependency it rewarded. This is not a conspiracy. It is a mathematical property of leveraged financial systems. The returns flow to those who are most exposed, until the reversal, when the losses flow to exactly the same people for exactly the same reason. The families who survived understood this dynamic, even if they couldn't articulate it in these terms. They were willing to accept a lower return during the good years in exchange for a smaller loss during the bad ones. They traded optimization for resilience. They sacrificed efficiency for survivability. And this is the decision that almost no financial advisor, no government, no institution will ever recommend, because the entire architecture of modern financial systems is built on the assumption that the system will continue to function. The families who survived were the ones who questioned that assumption. Not loudly, not publicly, just quietly in the decisions they made with their own resources, in their own homes, on their own time. Let me give you one more example, because it illustrates the full pattern in a single family. In Caracas, Venezuela, in 2012, a middle-class engineer named, for the purposes of this analysis, let's call him Alejandro, because the family's real identity has been kept private in the accounts that document their experience, began making a series of decisions that his colleagues found baffling. He paid off his apartment mortgage entirely, using savings that were earning a decent return in a Venezuelan bank account. His financial advisor told him this was a mistake. Interest rates on savings exceeded the mortgage rate. Mathematically, keeping the mortgage and investing the difference was superior. He converted a portion of his believer savings into US dollars through the informal market, paying a premium above the official exchange rate. His friends told him he was being reckless. The government had strict currency controls. The official rate was stable. Why pay a premium for dollars you didn't need? He invested in a small rooftop garden and began growing vegetables. His neighbors thought he had developed an unusual hobby. He also stockpiled basic medicines, particularly antibiotics and blood pressure medication for his elderly mother. His wife, a teacher, began tutoring students privately and building relationships with families in their apartment complex. They quietly kept their car maintained and their fuel tank full at all times, even when gas was essentially free in Venezuela. Between 2012 and 2014, every one of these decisions looked suboptimal. His colleagues who kept their savings in Bolívares earned higher nominal returns. His friends who kept their mortgages had more cash available for consumption. His neighbors who spent weekends at restaurants instead of gardening had, by every visible measure, a better quality of life. Then the collapse accelerated. Between 2014 and 2018, the Bolívar lost more than 99.9% of its value. The banking system became non-functional for practical purposes. Supermarket shelves emptied. Medicines vanished from pharmacies entirely. The families who had kept their savings in Bolívares watched their life's work evaporate. The families who carried mortgages found that while their debt shrank in real terms, their income had also collapsed. And the banks, before becoming irrelevant, had seized assets during the early phases of instability when they still had legal authority to do so. Alejandro's family was not comfortable. Venezuela's collapse was too severe and too prolonged for anyone to be comfortable, but they had dollars, when dollars were the only functional currency. They had food growing on their roof when the stores had none. They had medicine when the pharmacies were empty. They had a functioning vehicle when public transportation had broken down. And they had a network of neighbors who shared resources, watched each other's children, and provided security in a city where the formal institutions of safety had largely disintegrated. They did not predict the collapse. They did not know it would be this severe. They did not time anything. They simply built a structure of life that did not depend entirely on the system continuing to function. And when the system stopped functioning, their structure held. Here is the uncomfortable part of this analysis. The behaviors that protect families during collapses are the same behaviors that are socially and financially penalized during normal times. Holding cash instead of investing it, paying off debt instead of leveraging it, investing in skills and community instead of financial products, maintaining physical reserves instead of trusting supply chains, accepting lower returns in exchange for lower fragility. Modern financial culture is built on the opposite principles. Maximize leverage, maximize returns, maximize exposure to the system, trust the institutions, trust the currency, trust the supply chain, optimize everything, hold nothing in reserve that isn't earning a return. And for long periods, that works. It works because the system is functioning. It works because the institutions are solvent. It works because the currency is stable. It works right up until it doesn't. And the transition from working to not working is not gradual. It is a phase change, like water turning to ice. The temperature drops slowly, degree by degree, and nothing visible happens. And then, at one specific point, the entire structure changes state, instantly, irreversibly. The families who survive are the ones who prepared for the phase change before the temperature reached the critical point. Not because they knew exactly when the water would freeze, but because they understood that water, when it gets cold enough, always freezes. Always. In every country, in every century, without exception. At this point, there are only two kinds of financial systems in history. Those that have already experienced a major collapse, and those that haven't yet. There is no third category. There is no system that is immune. The variable is not whether, but when, and in what form and how severe. That's the constraint. It's not political. It's not ideological. It's mathematical. Systems built on compounding debt in a finite economy will eventually encounter a boundary. And at that boundary, the rules change. The families who had already adapted to a different set of rules were the ones who survived. There is one final observation, and it is perhaps the most important. The families that came through these collapses did not merely survive. Many of them emerged in stronger positions than they had occupied before the crisis, not because they profited from the suffering of others, but because in the aftermath of a collapse, when the system resets, the people who retained functional resources, skills, relationships, and physical assets became the foundation on which the next economy was built. In Argentina, the small business owners who had maintained dollar reserves and community relationships were the ones who reopened the first shops, restarted the first services, and hired the first employees when the economy began to recover in 2003 and 2004. In Germany, after the 1948 currency reform that ended the legacy of wartime and post-war monetary chaos, the families who had retained real assets and productive skills were the backbone of what became the Wirtschaftswunder, the economic miracle. In every case, the people who had prepared were not just survivors, they were rebuilders. This is not a reward for virtue, it is a mechanical outcome. When a system collapses, it does not disappear, it resets. And the reset favors those who hold real resources over those who hold claims on a system that no longer exists. This is historical and educational analysis, not financial or investment advice. Every individual's circumstances are different, and past patterns, while remarkably consistent, are not guarantees of future events. So what do you do with this information? That's not a question this analysis can answer for you. What it can do is show you the pattern, the same pattern, across a dozen countries, across a full century. The families that survived did not have secret knowledge. They did not have extraordinary wealth. They had something simpler and rarer. They had the willingness to prepare for a world that didn't yet exist while living in one that still seemed stable. They accepted the social cost of looking cautious. They accepted the financial cost of being less optimized. They accepted the discomfort of acting before the evidence was conclusive. And when the evidence became conclusive, they were the only ones who still had choices. The question is never really about what the family did. The question is whether you would have the discipline to do it before it was obvious, before it was urgent, before it was too late. Because the record is clear on this point. In every collapse, in every country, in every era, the people who waited for certainty were the ones who lost everything. And the people who acted on pattern recognition, quietly, without drama, without panic, were the ones who were still standing when the dust settled. The pattern is already in motion. It is always in motion, somewhere. The only question is whether you're studying it or ignoring it. This channel exists to study these mechanisms while they can still be studied calmly. If that matters to you, you already know what to do.